turned on the recording. Well, according to in the forum, as you can see, at least there are 7 people other than myself, and nobody is showing up. Well, I guess it's gonna be just the two of us. But the class will go on as usual, with either with one or one person or um, 20 people. It goes on. I just want to show you. Actually, I'm sharing my screen now. So I just posted. Um, and let's go to the announcement. I just posted. I just posted 2 things. Final final instruction. Where is the final? Oh, it's not posted yet because it's going to be posted tomorrow. But there's at least one thing. The last day and the face-to-face day of class, right? December 9th, next Thursday, because it's the last day of class. I don't know how many people will show up, but if more than 3 people show up, basically we'll be in the Murray building, right? 10:09. But if less than 3 people show up, then I'll be in my office and I will talk to you. Talk to like 2 people in my office, because because of the Omicron variant. I mean, it's not a safe thing to have more than 2 people in my office. Clearly, that's not a that's not a health conscious thing. I mean, but on I don't know what Murray 1009 is like. I mean, it should be at least a smart classroom, meaning one computer, the workstation at the instructor's desk, and the projector. Otherwise, we cannot do anything. Now, and then the final instruction will be posted tomorrow, right? Will be posted tomorrow. And you can already see that in the, if you go into the Connect, you'll see the final scheduled for these dates, okay? Alrighty. Oh, welcome, Ethan. You joined us, in the meantime. So you've heard what I said, Ethan. Right? You heard what I said. Come on, make some noise. Show some. I guess I lost Ethan. He's reconnecting. Alrighty. So whether we have 2 people or 20 people, the class goes on. Okay, you heard me. Good, good. So whether we have 2 people or 20 people, as I said, the class goes on. Okay. It says 3 people. Yeah, Ethan is still reconnecting. So continuing. So this topic is really an interesting topic. We just, I covered everything in the main lecture. Hope you have all, studied the main lecture, but reflection is, review is also important because that solidifies your understanding. So now we know what immunization is. This Ethan, I'm trying to. Okay, alrighty. Now we understand what immunization is. Just like you immunize yourself against um, any health shock. That's a kind of shock, right? If you get sick, that's a kind of shock, health shock. I would call it health shock. So immunization is a immunization of bond portfolio is basically immunization against any shock in price, because if interest rate goes up due to interest rate change, we may not have uh, the assets, sufficient assets to pay our obligations. But then, although immunization is we understand the concept of immunization, but uh, immunized portfolio needs to be uh, rebalanced every year. Why? Because as interest rate changes or yield changes, so does the duration, right? So does the duration. Duration changes too. So every year the position is not slightly, that balance is disturbed, right? So it may not be fully immunized. So then we need to realign proportions of assets in portfolio as needed. So let's take a look at this example. 11.2, constructing an immunized portfolio, right? Yeah, that's my the wood of my desk is chipping off. This is horrible. Let me just quickly fix it. I'll have to fix it later. But just let's put a tape around it. All right. So our obligation is 19,487 in and 7 years. If the maturity is now 7 years, then so originally our scenario was we have obligation to pay in year 5. So we are funding that obligation with a bond maturing in year 6, because then by accumulating all these coupon payments for 5 years, investing all these coupons for 5 years at the reinvestment rate, which is equal to the prevailing market rate, and then then by selling that bond at the end of year 5, which is the beginning of year 6, right? Then we can exactly match the obligation, in other words, our liability, with our assets, and then it will immunize our portfolio from any shock from slight changes in interest rate. When the prevailing market rate goes up by 1%, our our asset side, our bond portfolio is fully immunized. We can still, but that in our original scenario, our timeline was 6 years. In other words, 5 years for our obligation and 6 years for our asset side, our bond portfolio, right? But somehow in this, let's say, if the maturity is 7 years, then our obligation will be 19,487. Let's see. Oh, and the scenario is, of course, different. Yeah, the present value of 10K at the interest rate of 10%. And of course, we know we can easily using the calculator, right? 10,000 times 1.1 raised to 7. Yeah, well, that's our obligation. So a little different, scenario now. Now they want to fund it with 3-year 0 coupon bond and annual coupon perpetuities. You know what perpetuity is? Perpetuity is a annuity that goes on forever, right? And if you remember from Finance 100, perpetuity is a typical example of perpetuity is a preferred stock that pays fixed dividend, right? That pays fixed dividend. So in case of perpetuity, how you calculate the present value of perpetuity. Where is my whiteboard? Okay. Get out of there and let me create a new one. So I hope you all remember, from Finance 100, how we do the perpetuity. I mean, it's the case of zero growth model, or zero growth or constant dividend model. Remember? I mean, also we did, at the beginning of the semester, we reviewed the stock valuation models, so it's, a constant dividend or zero growth model. Exactly. Oops, zero growth or constant dividend. And that's perpetuity. It's also called the perpetuity model. Perpetuity. And in that case, value of the stock, dividend over R, right? You remember that? And then, so we want to fund it with, a 3-year 0 coupon bonds and annual coupon perpetuities. So like, annual dividend perpetuities. So then calculate the first thing is we need to calculate the duration of liabilities. And because this is, a 0 coupon, our liability is a 0 coupon bond, meaning, you put, 10,000 today into this, the clients, right? Your clients are putting, $10,000 with you, and this is a guaranteed investment contract, right? So in 7 years, you will have to return. You will have to pay them 19,487, right? So it's a zero coupon bond. It's exactly just, just like a deposit in the bank, just paying 10% interest, and 10 years later, you're gonna pay it out to the client, okay? And I've been telling you, zero coupons, duration of the zero coupon is the same thing as the maturity. So duration is 7 years. And let's find out about the duration of our assets. And duration of the zero coupon, I've been telling you, is the same thing as the maturity. So we are trying to fund it with 3-year zero coupon. So for zero coupon, the duration is 3 years. And as for perpetuities, I've also we talked about this duration of perpetuity, right? Duration of perpetuity is 1 plus R over R. That is, right? 1 plus R over R, right? Right? That's plus. So then the question becomes, how much proportion, right? How much of, how much of the our assets must be put into zero coupon, and how much of it must be put into perpetuity. So in other words, so let's call the proportion of, or the weight in zero, W, meaning weight, right? And then obviously the proportion that goes into the weight of the perpetuity will be 1 minus W. Then we set it equal to 7 years, which is the duration of our obligation. So no, I don't even need to use this. So duration of our assets, we must match our assets duration with the liabilities duration. So assets duration will consist of, W times 3 years, which is the duration of zero coupon, which is equal to just the maturity, plus 1 minus W times 11 years. How do we know it is 11 years? Because duration of perpetuity is by this formula, right? We find 1.1 over 0.1, we get 11 years. So times 11, and we set it equal to 7. And then we solve for W. Right? So then, W, let's do this. It's not a difficult thing. So W3 times 1 minus W11 equals, 7, right? Then, even a sixth grader can do this, right? Times 11 minus W. Actually, you should write like, 11W, right? Okay. So then, 7, right? Move this to the other side, right? That's going to be minus 4, right? to the other side. And then here, that's going to be minus 8W. Then W will be half. So that means we put 50%. We put 50% of 50% in of our 10K, because what we receive from our client is 10K. Put 50% of 10K into 0 and 50% into perpetuity. So 5K into 0, 5K into perpetuity. Now, then let's find the future value of these assets. Zero coupons, maturity is 3 years. In other words, 0 coupons don't last. We are deliberately putting our 5K into 0 with the maturity of 3 years. So future value will stop at year 3. 5K times 1.1 raised to 3, because or 10%, right? And the present value of the perpetuity at year 7. You might wonder, why present value? Isn't that the future value? Yes, it's the future value, but think about it. It's the perpetuity is valued. Perpetuity is valued at that point. In other words, we're gonna sell this perpetuity, right? We're gonna sell this perpetuity at the beginning of year 7, or at the end of year 6, at the end of year 6, or at the beginning of year 7. And at that point, what is the value of the perpetuity at that point? And of course, then it is the present value as of year 6, as of end of year 6. You understand? All valuation models are basically present values, but when you say present value, it doesn't mean necessarily present value can be a present value as of time 0, right? Or it can be present value as of year 7. That means this is the discounted future cash flows. Sum of all the discounted future cash flows, right? Where T starts from 7 through N, right? In other words, what is the value of this? What is the value of this perpetuity at the end of year 6, which will generate endless, perpetual stream of cash flow, right? From the end of year 7, right? From the end of year 7 and on, right? Does that make sense? So therefore, and we know what how to value perpetuity. It's the dividend over R, and the dividend in this case is 10% of 5K, so 500 over 10%. And since you are putting 5K into that, 5K times that, so that will be, and if you calculate that, think about it. We get that. So 5,000 times 1.1 raised to, what did I do? Once again, that was 5,000, I'm sorry. It was 5,000 times 1.1 raised to, right? Plus 5,000 times 500 over 0.1. That's gonna be, oh, that's gonna be a little weird. That's a little weird. That's too much. 25 million. What went wrong? 500 over 0.1. That will be 5,000. That'll be 5,000. What is the let me rewrite this. So our asset side, right? Our assets will be you put 5K into zero coupon. That's gonna be, right? And then I think it's not, the other 5K is put into the perpetuity. What's the price of the perpetuity? Oh, the price of the perpetuity is 5,000, so you can have only one. 10% of 5,000 is 500, right? Divided by 0.1. This is the present value of such. This is the present value of such such a perpetuity. So in year 7, so I think then I will need to discount it by, because this needs to be discounted by 1.1 raised to 6, because at the end of year 6, this is the value of such a perpetuity at the end of year 6. So you discount it back to present, and then that's 5,000. It's 5,000 divided by 1.1 raised to 6. Okay, it's 2,822. So you can buy about so you can buy about like one with $5,000 now. I will so flip it. Okay, times 5,000. It's like dividing by that. Yeah, you can buy 1.77 of that, 1.77 shares or units of such a perpetuity. So basically then 1.77 and times, because you're buying, you can, with 5,000, you can buy as much as that. And in year 7, it's going to be, and by 0.1. Yeah. So it's going to be like this plus 5,000 times 1.1 raised to 3. Yeah, you'll have something like this. 15. Then the problem is you can't cover. I mean, you need to have, I think the original, I don't know why, but the original, but the original one doesn't. So I think I will have to, during the break, I will have to recalculate this because you understand what I'm saying? The obligation is 19,487, but the way it looks, the zero coupon, 3 years, right? That's going to be this. And then perpetuity with 5,000, you can buy, I mean, this is the present value of such present value at time 0, right? This is the present value at time 0 of that perpetuity, present value of that perpetuity at time 7. So maybe I should have, discounted it by 7. But then, you can buy 1.77 units or shares of such a perpetuity, right? And then if that is, if I do that, then, I only end up with, 15,512. So I cannot beat it's not immunized, right? So maybe, it should have been 7. But I'll check that, after, during the break. But this is the idea. And then that was year 1. And then rebalancing of that example in year 2. So portfolio in year 2 with, still the same coupon rate of 10%. Is it still fully funded and immunized? So now, what is the liability year 2, future value 2, the year 2 value of the liability? In year 2, our liability is 11K because we are 1 year closer to the maturity, right? Think about it. At time 0, our obligation, the present value of our obligation, in other words, what the clients deposited with us was 10K, right? 1 year later, this will be 1.1K, right? 1 year later, it has to be 1.1K because it grows by 10%. So that's what it means. And then if we So if we still put 50% into 0 and 50% into perpetuity, it's going to be 5.5k. We're going to put 5.5k into 0, 5.5k into perpetuity. But 0 has now 2 years left to maturity, right? And our obligations timeline has been reduced to 6 years because we are now in year 2, right? So then we still do the same thing. Set the weight of the 0 as W, and 1 minus W is the weight of the perpetuity, with the duration left, right? Duration of the 0 is always same as maturity, right? Duration of the perpetuity is 1 plus R over R, still 11, but the obligation duration of the obligation is now 6 years, and our obligation is 0 coupons, so time left to maturity 6 years. That's the duration. And if we solve for W, it's going to be 5 over 9. Okay, so it's not exactly 50-50. So then we put 5 over 9 into zeros. Then it's 11k times this, 6,111, and then 11k times the other half, right? It's not exactly half, 4 over 9. Then that's 4,888. So we put that in the perpetuity. And then here's the thing, I mean, theoretically that's so, but in reality, can you buy how much, I mean, is there a perpetuity that how many shares can I buy with 4,808? So so as a practical issue, right, what they suggest is to put entire coupon in 0, right, and sell 111.11 of perpetuity, right? So this is a little kind of tactical issue, right? Tactical issue. So I'm not we're not going to dwell on this. We're not going to dwell on this longer, because how we split it. So it's like some tactical variation. So basically the idea is, but the weight, because the weight will be like this, then this is what you put into 0, this is what you put into right, perpetuity. But think about it, because it's hard to buy only 111. I mean, how would you buy zeros with $111, right? That's a bit weird. You cannot buy not even a single 0 coupon bond with 111. So what tactically, you just buy 6 of them, and then buy 5 of them, and sell, right, 111 as much as 111 worth of perpetuity. So this is again the tactical split, but again there will be too much transaction cost for this small tactical split. So continuous rebalancing is not feasible actually, because so less frequent rebalancing in reality. I mean, every year, every year, right? But not not continuous rebalancing, like every second, every minute. So if rebalancing is such an annoying job, then why not, as an alternative, what came up was, why don't we just match the cash flow? This is a simple solution to rebalancing. Matching cash flows from fixed income simply by zeros with future value equal to obligation, right? Well, then, our problem solved. You just buy. But theoretically, this is simple. But think about it. What you're offering your client. I mean, when you took $10,000 from the client, promising 19,000 something in 7 years, right? I mean, that's already a zero coupon bond, right? It's a guaranteed investment contract. That's already a zero coupon bond. In other words, you're selling zero coupon bond to the client, and you are funding it with another zero coupon bond. That's ridiculous. I mean, you're not making anything if that's the case, right? If that's the case, you are funding it by putting that $10,000 into a zero coupon bond that will pay you 19,000 something at maturity. Then what's that? There is nothing for you. You are exactly, I mean, think about it. Such a zero is exactly the same thing. It will be a zero coupon bond that pays 10%, right? I mean, it's a zero coupon, so it doesn't pay 10%, but it grows at 10%. It grows at 10%, right? With a growth rate of 10%. So then, 7 years later, you'll be able to, 7 years later, you'll be able to pay your clients this amount, but then you just move the money. I mean, you took 10,000 from the client, put that 10,000 into another like zero coupon bond that grows to 19,487 in 10 years. And you are simply, basically, what do you call shuttling between? You're shuttling between, your client and your investment. I mean, whoever is going to pay you 19,000. In other words, nothing left for you, right? So theoretically, it is valid, but it's there is no merit in this. I mean, unless cash flow is not exactly matched, but in other words, you sold a guaranteed investment contract that will grow at 10% a year for 7 years, but with your client's money, 10K, you put it into something that grows at like 11%. 11% a year, then cash flow is not matched. Actually, you have more cash flow on your asset side, and you pay 19,000 something to your client, and you will get on your asset side, it will be greater. So you'll have something left for you, right? So theoretically, yes, valid, but practically this doesn't really, cash flow matching doesn't really make sense. I mean, you can, in other words, what I'm saying is, future value of your obligation, right? Future value of your obligation should be less than future value of your assets, right? If you have more assets, the future value of your assets is greater than future value of your obligation, then that makes sense. In other words, then this is not cash flow matching. This is actually, unmatching, right? Okay. Now, the next strategy is called dedication strategy. Dedication strategy is called, also multi-period cash flow matching. So what you do is buy zeros or coupon bonds with cash flow equal to obligations. So it's like, it's pretty much like, this cash flow matching, but it's not only zero, but, with coupon bonds. And pros are, there's no need for rebalancing. Cons, constraints on bond selection, because it's not widely used, because it's impossible to immunize with undervalued bonds, because you want to change in interest rate will be irrelevant. These firms want to immunize using undervalued bonds. Of course, you want to, because in the future it will be, you want to do it with, undervalued bonds today. So the bond values are less than $100,000, $10,000, and then in the future you will have something more. The future value of those, assets will be greater than the obligations. Exchange, and then you are exchanging exact and easy dedication for superior returns. In other words, you want to have superior returns. Yeah, that's what I'm saying. If you are a money manager, if you are a fund manager, why would you do this, right? You don't. I mean, so you want to make it like this, right? That's what it is saying. You're exchanging exact and easy dedication for superior return, but impossible to cash flow match pension perpetuity, because perpetual payout of income to current and future retirees requires purchase of fixed income securities with maturity greater than 100 years, because you have to constantly pay out to current pension clients and future pension clients. And such securities do not exist, with maturity greater than 100 years. It doesn't. So dedication is not feasible. Um, so uh, so that wraps up everything about immunization, right? So we're gonna. It's about time to take a break. It's 6:57, so we're gonna take a 10-minute break and come back at around 7:10. Okay. So, but we're gonna, before we move on to convexity, we're gonna do some exercise of rebalancing or immunization, not rebalancing, but immunization. Okay. All righty. So let's take a 10-minute break. All right. So I'm glad to see you, Casey and Giselle and Ethan. All right. So 10 minutes. right, we're back. We're back. So we're gonna be doing this this exercise about immunization, right? Here, this file is actually, this file can be found, right? If you go to our topics folder, right? If you go to course material, I guess I was already in course material, no? You go to course material, topic 3, right? You see this file, immunization practice, right? Please download it. Please download it. And if you have downloaded, please open it. Do you have this file in front of you? Anna, do you have this file in front of you? Anna?
Yeah, I'm opening it now.
Okay, okay. Ethan, do you have this file in front of you? Ethan?
Yes.
Okay, good. Giselle, do you have this file in front of you? Giselle? Make some noise, huh? Give me some vital sign. Akisi, do you have this file in front of you? Akisi? I guess it's only two of you, Anna and Ethan. I know who are my best students. Okay, if you have that file in front of you, it may not look exactly like this, but these, all these are blank, basically. Do you see, they aren't they blank? Are they filled in? They must be
Mine
blank.
are blank.
Yeah, it should be blank. So, yeah, I already worked it out, so they are not blank, but let me turn them into, but these are initial data, so they must be filled in. So if these are blank, please fill them in. Just, manually enter these numbers, okay? And then they must be. So what we are trying to do is to immunize our portfolio that has $1,000 portfolio value. So $1,000 portfolio value value is just like one bond, but we can just multiply it by 10, and it's going to be it's going to be like the like our example, which is remember this example? We're trying to replicate this. In other words, we're trying to replicate this example, right? We're trying to replicate, but it's 10,000 here, 10,000. But we just scaled it down to 1,000, right? We're trying to replicate that example. So first, yield to maturity is 8%, coupon 8%. So then we know when the coupon rate and yield are the same, then it must be a par value. I mean, it's the bond must sell at par value. Market price must also be 1,000. But we'll and then the maturity is 6 years, duration is almost 5 years. I mean, holding period is 5 years. We entered it as 5 because your obligation will have to be paid at the end of year 5, right? So although your assets maturity is 6 years, right? That asset must be liquidated, sold at the end of year 5, which is the same thing as beginning of year 6, and then it must match our obligation, which is 1,000 in this example. Excuse me a second. Oh God. So let's first find the market price. It says market price, but it's actually the rational price of, or the fair value or intrinsic value. We just hope that it will be, market will be in equilibrium so that the market price is correctly priced. If the market price is correctly priced, then it should be equal to the intrinsic value. Okay, and we know how to find a bond price, right? Somehow in this what do you call this, comment box, the wrong formula is there. The formula that you see there is actually duration formula. It's and you remember this duration formula. It's a different. There is a duration formula using calculus, and the duration formula using Excel's built-in function, or a duration formula like this. And that's what we are using here, because to use Excel's built-in function, we have to have like settlement date and maturity date, and none of that is available. So we'll have to use this formula, right? And finding the bond price is, something done in the Finance 100, also reviewed, as the first topic in this class. So basically what? Payment over R. So our payment, we can find a payment, like, payment is this times coupon rate, or, and we assume annual coupon payment. Not, you all know bonds pay coupons semi-annually, right? Semi-annually, so twice a year. But we just, we'll just use simplifying assumption that the coupon is paid once a year. So we're not going to assume, semi-annual. So it's going to be, simply then divided by R minus, again, coupon payment, which is 1,000 times coupon rate, or now R times 1 plus R is to N, just 5 years, because you're gonna, right? And then plus, that's only the coupons, right? Those are only the coupons, isn't that right? That's only coupons. So we need to then, at maturity, we get $1,000. So we discount it to present. So 1,000 over 1 plus R raised to 5. That way, it's going to be exactly 1,000, right? It'll be exactly. What did I do? Hold on. Let's say yes, but no, it's not. That's not it. It's not there. Oh, here. Forgot. Oh, not, then it should be exactly 1,000 because it's a coupon rate is the same thing as the yield, so it has to be a par value bond, selling at par value, right? And let's find the duration using this formula. This is a headache. It's going to be a headache, right? Uh, uh, if you put, this formula, right, like this, it's going to be like this, okay? It's going to be like this. So B5, right, minus, open parenthesis, and B4 times B6 divided by B3. B3 is this times B3, close parenthesis, and close another one, and then times B5. B5. Okay. Let me just enter it like that. And, let's stay like this. So B5 times V5 minus plus E3 is what? The yield, close, and times, open, 1 minus, open, 1 over 1 plus E3, close parenthesis, raised to E5 over E3, close parenthesis, close again, parenthesis, 3, 4, right? 1, 2, 3, 4, or 4 parentheses. Hit enter. Something's not right. I messed up somewhere. It should be 4.99. B5 minus open parenthesis 3, B4 times B6, divide D3 times B3, close, times B5, okay. B5 minus, that wasn't all that. That was that error. Must be 3 times, open, 1 minus, open, 1 over, open, 1 plus B3, close, raised to B5, close, divided by B3, close, full close, close 4 times, right? Hit enter. Why? What's wrong? Again, it's trying to B5 minus B, open, D3, B3, close, times, open, B minus, B5 minus, open, 1 plus B3, times, open, 1 minus, 1 over 1 plus B3, B5, close, like this. Oh, no, I'm sorry. I'm sorry, what did I do? Why did I do it there? Okay, here. And I have another, right? Hit enter. Why does it keep? Yeah, whatever it corrected it right. So let me b5 minus b4 times b6 slash b3 d3 times b3 close times b minus b5 minus open 1 plus b3 close times open 1 minus open 1 over open 1 plus b3 close raised to b5 close divided by b3 close. Okay, there you go. So the duration must be 4.999, right? So did you all get this duration 4.99? It's kind of it's a hassle.
Could you hover over the market price one again? Because I'm missing like
Market
the last
price,
piece
okay.
of that.
Okay.
Okay, thank you.
Mm-hmm. Got that? How about you, Ethan? Did you get it right? Ethan?
Yes, I'm getting there.
Okay, good. So now we are assuming, but then, let's try this, just like it's the same scenario, just like our example, immunization example, but, it's just scaled down by 10, scaled down by 10. You understand? Because, so everything is just scaled down by 10. You will see, if it is $10,000, I mean, if our portfolio value is $10,000, you will see exactly the same numbers here and here, like the ones you saw in this example, right? It will be just, scaled down by 1/10, right? All right. Next, if the rate increases by 200 basis points, or by 100 basis points, what does that mean? 100 basis point is 1%, right? 100 basis point is 1%. So what this means is our rate is going to be this, and I will lock it because, use F4, right? Function key F4, because I'm going to copy this, to the 0.01. I hate to enter it manually, but let's just enter it 0.01, and then it's going to be 9%, right? In this case, it's going to be, I'm going to do it later. Future value of coupon payments, right? CPS coupon payments, I believe that's what it means. Because think about it, if you took $1,000 from your client, and 6 years later, I mean 5 years later, you will have to pay them back. I mean, in this example, you will need to pay them back 14,693. So in other words, in our example, is scaled down by 1/10. $1,469.32 or 33 cents. So to do that, you are putting it into a bond, coupon bond that pays, 8%. That pays 8%, but 8% coupon. But the yield, the prevailing market rate has gone up by 100%. I mean, not 100%, 1%, 100 basis point, right? So then what's going to be the future value of all those coupons? The coupons are basically, $80, aren't they? Coupons are, and then it is, see this cell calculates the future value of the coupons, assuming a one-time change in the interest rate. The future value of the coupons are equal to the future value of, and it's an annuity, right? Annuity, right? It's an annuity. So we know it's going to be, the annuity is, the payment will be, and I'm going to lock, times the coupon rate is this. I'm going to also lock it, because the coupon, this bond will, so we follow this form. This is the future value of annuities, right? Times, and then open parenthesis, open another parenthesis, 1 plus, and when interest rate has changed, we're gonna, then this discount rate, the interest rate, and the interest rate will be, 9% now, raised to 5 years, because your holding period, excuse me, so the, first coupon, second coupon, third coupon, the coupons will be reinvested, right, at 9%. 5 coupons will be reinvested at the end of year 1, year 2, year 3, year 4, year 5, and then and I'm going to lock that, right? Minus 1, close parenthesis, divided by 9%. So the future value of all those coupon annuities is going to be like that. And the sale price of the bond, in other words, market price of the bond, I don't know why, maybe I call it, I better call it market price, right? But they say sale price of the bond. That's fine. Market price or sale price, basically. But we are also, it's an equilibrium model. In other words, in an equilibrium, the market price will be exactly the intrinsic value. But in reality, it may not be the case. It will be always, either less underpriced or overpriced. So basically the same formula as this, but with new discount rate. So then payment, we know the payment is times, and I better you better lock them, because we're gonna copy this to the other columns. Lock, and then divided by our new rate is this, minus, again, I'm gonna copy, because it's, and paste, divided by open parenthesis, or times 1 plus r raised to n, and then lock that one, lock that, so that, and then that's only the coupons, right? That's only the present value of the coupons, the annuity, plus we'll have to discount the par value, right? The par value is that thing. You want to also lock it because I'm going to copy that. And then plus this rate, these two, 5, and you want to lock it too. Okay. Okay, you're good so far. And I'm going to hit enter. Why? Let me. That must be the correct one. F12 minus P6. F12 times 1 plus F12 raised. Oh, here, I should have. I forgot to close this. This is necessary. Okay. All righty. So think about it. At the end of year 5, right? The sale price of the bond, will be 961. Okay, 961. Because why? Because the rate increased by 1%, so it's deeply discounted. I mean, it's discounted more than when it was 8%. So it's going to be this. And then together with the coupon, reinvested coupons at the time, the total will be sum of these two. It comes to $1,439.88. So compare it with our example. Just scale it by 10. I mean, if we had $10,000 in our bond portfolio, this would be $14,398.80 something. And let's compare that with our scenario. So if the rate went up to 9%, 14,696.02. It's a slightly different, but 14,696. Oh, what could have possibly gone wrong? Maybe, and the thing is, this is what we need, right? This is what we need. This is our payment obligation, 14,693. 14,693. Scale it down by 10. 1,469.33. 1,469.33. 1,469. So we cannot even. It's not even immunized. What went wrong? Well, where did I? Let me check. I did it also in the another file, bond exercise, right? This one you have it there, bond exercise. I did it also here. When 478,990. What was wrong with that? 478 is correct. This has to be 990. Why? What went wrong? Let me check. B6 times B4, that's coupon rate, right? Over F12, right? Minus B6 times B4. over F12 R times 1 plus R raised to B7. Right, plus B6 power value. Where did I go wrong? B6, B18, B16, B18 over E28. E28 is what? 9%. B16, B18, E28, 9%. Ah, ha, 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 ha. B17 minus B20. B17 is what? I see. Oh, yeah, yeah, you have. Ah, this is what I got. Okay, here's the thing. Okay, so here's the thing. Okay, I'm sorry, my mistake. My bad. When you are discounting it, right? You have only, we are trying to find a price with 1 year left. Isn't that right? With 1 year left. In other words, we are trying to find the price of this bond at the end of year 5, right? And this bond has, 1 year maturity left because the maturity of this bond portfolio is 6 years. And we are trying to find the price of that at the end of year 5. So actually, you are not discounting it all the way back to year 5, but you are discounting it just 1 year. So what should have been done was that minus, oh, what happened? What did I do? Okay, so I should have, open the parenthesis, and then actually E5 minus B7. So lock that, and it should be, everything should have been like that too. So it's raised to like that, and then close parenthesis here, and here too. I should have done E5 close parenthesis, lock minus B7 close parenthesis. No. What's going on? Close parenthesis. Okay. There you go. There you go. Now we are immunized. Now we're immunized. Okay. So you want to see, okay, you want to see what's in there? Yeah. You're okay with this? Anna, are you okay with this? Anna?
Yeah, I'm just getting that last bit.
Okay. Ethan, are you okay with this? Are you
Yes.
okay with? Okay, good. All right, we're all done. Let's just find then internal rate of return. Internal rate of return is basically what is the compounded annualized return. So we just use in this case we'll use rate function. I mean, we can solve this with our rate formula, but just for the sake of time, we'll just use Excel's built-in function. So we go to if rate is found here, that's fine, but not if not, go to financial, and then go to rate. Hit OK. End periods. End periods should be 5. So I don't think we need payment. So we skip that. Present value. And we got to make that negative. Future value. No. What should I use as future? And then, yeah, we're almost there. Hit OK. Yeah. So if the rate increased by 1%, our actual, internal rate of return, which, is the rate that makes our total equal to our, or if you're buying it now, it should be the cost of the investment is this, and this is what you get. So it should be like 8.2%, right? Should be like 8.2%. What? Did I got it? Internal rate of return is. So if I did it, E31, if I did it like this, E31, B19, one over B20. Oh, did I? Let me check it with my other work. That's okay. That's all right. Maybe why? I'll follow my own formula, right? The rate formula is basically, but E31 is fine, but B19, B20. Why market price? It should be. Oh, I see. I'm losing. I'm sorry. I'm losing sight of the. I'm losing the perspective. Because look, it perfectly makes sense. Okay, so instead of F14, let me use this, and let me lock it. B7 is okay. Lock that too. Okay. And it should be 8%. You know why? We shouldn't lose perspective. Think about it. When you originally bought this bond, it was $1,000, and at the time the coupon rate, the prevailing rate in the market was 8%, and then after that, rate increased by 1%. So basically, in calculating, the rate, you see the present value. In other words, the price you paid was not this, but it was this. It was this. I mean, that's originally what you paid, but then the rate changed, right? So this is not the price you paid. Obviously, this is the price now in the market, right? But this is the price you paid. So by making that correction, then you'll get exactly 8%. Now, I'm going to copy this next. If the rate, let me copy. And then if the rate increased by 200 basis points, I'll just paste it here. Everything will work. Oh, here, this one I'll have to change to 2, right? And then, and we're still immunized, right? We're still immunized. Our payment obligation is, what was our payment obligation? 1,000, if you remember, right? Our payment obligation is $1,469.33. So we are immunized, whether increased by 1% or by 2%. I'm gonna also paste it here. The reason I locked and all of those, because some variables must be locked. So then you can, but the only thing that should be left to change are these, and things that I didn't lock. But let's say, so you paste it here. I have to copy that again. And then paste it here and make some adjustment. Now, rate decreased by 1%, so -1, right? Minus 0.01, 1%. Hit enter. So the interest rate, prevailing market rate is now 7%, and then everything has changed. Yes, we're still covered, still immunized, right? We're still immunized. And then again, I'm gonna copy this. Paste it here. Now rate went by 2%. 2, right? And we're still immunized, aren't we? We're still immunized. So everyone is good. Everyone is okay up to this point.
Yeah, I'm following.
Good, good, good. Yeah, you're dependable, Anna. Ethan, you're good?
Yeah, I'm good, Professor.
Okay. Okay, good. So now we under, like 4 scenarios, our portfolio is immunized. Okay, our portfolio is immunized. When the rate changed by 1%, up and down. When the rate changes by 2%, up and down. And if you just make this 10,000, that will be exactly like our example, right? It will be exactly like our example, right? It will be exactly like our example. If you just, all right. So that's the exercise of the immunization. It's 7:57, so it's a pretty good time to take a 10-minute uh, break. So we'll reconvene at uh, about 7:10. Okay, I mean right? 8:10, about 8:10. We'll reconvene. All right. I'll leave this on just in case, and I will control. I will leave the formula view. Oh God, it's crazy. So it won't help much. In the formula view, I don't think it's going to help that much. Because why? But at least. Okay, I guess this will. I'll leave this on. All righty. All right, we're back. We're back. Looks like Giselle is lost. So our next topic is the convexity. And what is, so this is a little, heady subject, heady topic. What's convexity? We all know what convexity is because, the curvature, we know, see the bond price movement has a curvature, right? And the curvature depends on, that curvature is called, convexity, because the curvature doesn't, it can be more pronounced or less pronounced. And here, this brings us back to this this picture. And as you can see, bond D, the price movement of the bond D with respect to the movement of the interest rate, bond D's curvature is more pronounced. Whereas, bond A, the curvature is very, there is very little curvature. It's almost like a flat line. So, and then the change in bond price with change in interest rate is relatively not dramatic, right? For example, interest rate went down by 5%, but it didn't really, bond price didn't really, the bond price didn't really change that much, at best 10%. I mean, this might be like 20%, but when it went down by 4%, just about 10%. And when interest rate went up by 5%, right? Interest rate went up by 5%. The price didn't fall that much, right? The price fell probably at best 10%. So what kind of bond is that? We know high coupon rate, short-term maturity, short maturity, and high initial yield. As opposed to, and so there is hardly any curvature. The curvature is very, what should I say, attenuated or very, unpronounced, right? Very meek. What's the word? Very slight. And as opposed to that, something like D bond D, look at when the interest rate went down, the price went up by almost 160%. When interest rate went up by 5%, price dropped almost by 50%. So, and then a bond like D, bonds like bond D has a very pronounced curvature. Now think about it. What is the duration? I told you duration is the slope of this curvature, right? Slope of the curvature. That's the duration, right? It's the first derivative of the curve. And the first derivative of the curve is a straight line, right? So, and I've been telling you, see if the curvature is so pronounced like this, right? Then the slope is all different at every different point, right? The slope is, slope can be like this, 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 slope is, can be like this, very flat. I mean, that doesn't look right, but slope can be like this, right? So if the bond price change has very pronounced curvature, then the duration cannot really make a good prediction. Why? I mean, suppose this is 0, right? So let's say this is 0% change in the 0% change in the yield, interest rate, right? And this is the bond price. And for a small change, like -1% or 1% change, right? Duration will work, right? Because it's pretty much a flat, curvature is not pronounced. Small change like 1% change, duration can predict, right? Rather, duration can predict correctly how much the bond price will. This one is not. The graph was not correct. Let's say the graph should have been more like. Let me erase this part, and the graph should have been more like this. I mean, this is not this. Why did I draw it like this? But you understand what I'm saying, right? The curvature, right? And then if that's the case, for some changes like small changes like 1% change, duration can predict the bond price rather well, but then when the curvature is like this, I mean for a large change, think about it. If you extend this slope like this, if you extend the slope like this, predicting the bond price by this slope is clearly incorrect, right? So actually, the duration to the duration will be all different, like arc elasticity. Duration is all you will need different slopes for different segments, right? You will need different slopes for different segments, and that's going to be a it's going to be a hassle. And and the slope that we use is like a like generalization of the slope of the curve. So, but the generalization will be missing a lot when the curvature is so pronounced. if the curvature is so pronounced, right, it's not going to do a good job, right? So then that's why we need the convexity. Now think about it. Okay, I'm trying to tie my pen to my wrist so that I won't. Okay. Now think about it. This I've been telling you since last class. This is like a quadratic second order quadratic function, right? Quadratic. Meaning, second order, right? Like, alpha times x squared plus beta times x plus gamma, right? So if we can approximate this, right? If we can approximate this equation of the curve, then we will have a better way of predicting bond price change when with respect to interest rate change. Okay, so that's what the convexity is all about, because the curvature has convexity. So I know this is a very this is not an easy topic. It's you need the understanding of calculus. So now think about it. Duration is basically the slope of the curve. So it's the first derivative of the curve, first derivative, right? First derivative. And convexity is the derivative of the derivative. In other words, convexity is the change in duration with respect to change in yield. So it's second derivative of the bond price. Duration is the first derivative of the bond price with respect to yield. Convexity is the second derivative of the bond price with respect to yield. Okay. So then, how do we derive, convexity? So it's kind of I try to put it here as much as I can, but the full steps of derivation is kind of two-step. The first step is basically the first step is basically the step to derive from duration to convexity, and then second step requires a technique called Taylor series expansion, which you hopefully you would know. But I put everything here, but let me show you the full. I think this is easier. I put it here. Let me see. I just, let me check if I'm not speaking to the hollow void. Okay, I have Anna. Anna, are you still there, Anna?
Yeah, I'm still here.
Okay. Yeah, you're really dependable. And Ethan is gone. Larissa, are you there, Larissa? I guess Larissa is not even there. So it's just, then you and me. Just, think of it as a tutoring session. So here's, now let's think about what is duration. Duration is basically, change in B over change in Y times 1 plus Y over B. In other words, it's elasticity. It's just like elasticity. Originally, it was, let me write it here. It's Macaulay duration. So it's basically a percentage change in bond price over percentage change in yield. Okay. So this gives you percentage change in price. This gives you percentage change in yield. Right? And this was originally, you remember, it's, change in 1 plus y over 1 plus y. But then again, 1 doesn't change. 1 is constant, right? It doesn't change. So the only thing that changes is this. So y, that's why, just change in y. But then dividing of, fraction, something by fraction is like, multiplying by the reciprocal, right? So that's why, so this is like change in B over B times 1 plus y over change in y. But then, the denominators can be swapped, right? So then I swapped it like this. And this is in calculus, this is, discrete. This is discrete differentiation, and this is, continuous. Still delta, but when you change delta to this, that's, continuous differentiation, continuous. And the modified duration is duration divided by 1 plus y. Then, if we do that, this is Macaulay duration times 1 over 1 plus y. They cancel out. It becomes dB over dy times 1 over b. And then C is, convexity is the second derivative of this, second derivative of bond price. So it's the derivative. Basically, you are taking the first derivative of the duration, which makes it the second derivative of the bond price. So then, it's like this. This is the second derivative. Or if we use modified duration, it becomes, d times, modified duration over dy equals, d over dy, and then this is the modified duration, right? So then, because the then C will have 1 over B, right? Which is like, tagging along. So if you multiply both sides by B, it will be, nicely, this B and B will cancel out, and you will have D of delta, D of D star, this is, this is basically, D star. So delta D of D star over dy times B. Okay. And then so this is basically, a derivative of two functions. It's the derivative of two functions. Why? This is a function that is differentiable with respect to y, because think about it. Duration is the first derivative of the bond price. Bond price is basically a function of the rate, function of y, right? Function of the interest rate, right? So this is differentiable with respect to this. B, once again, B is a function of y. Bond price is the function of yield. So we have two functions that are differentiable, meaning, you can take derivative of these with respect to y. Okay. Function one, f function one, let's call that function f. Function two, let's call that g. So function one is basically d star. Function g is b, right? And then if you take the derivative, f prime means, first derivative of function f, right? F prime, we know what is, first derivative of d star. And then it had, B already tagging along. That's the, actually, I missed, I should, where is this coming from? Okay, this B isn't supposed to be here, but somehow, okay, I'm gonna have to fix it later. And the okay, can I should bring it to, the cursor doesn't move, so ignore that B there. Oh yeah, no. Why isn't it? Okay, ignore B there. And then G prime, which is the first derivative of G. Okay, why is it? Okay, here. Ah, good. Yeah. And then G prime, which is, basically first derivative of B with respect to Y, which is exactly the modified duration. Okay, so in one of the in calculus, one of the rule of calculus is when you are taking first derivative of the product of two functions, then what you do is you take first derivative of the first function times the second function plus first function times a first derivative of the second function. So invoking that rule, right, we do then f prime g will be d of d star over dy times b, right? And f times g star will be f is d, f is d star, so d star times d star. Then combining these two by this rule, combining these two, then we have d of d star over dy times b plus d star squared. And then from here to here, that's where the Taylor series expansion comes in. And with the Taylor series expansion, which is, I don't want to go over this, but you can check it out later. Eventually, we arrive eventually we arrive at, through that, we arrive at this. Okay, we arrive at this. So then think about it. This is a second order function, second order, right? Quadratic function. If it is a quadratic function, as a quadratic function, it can replicate the curvature. It can replicate the curvature, right? That's the in other words, it is the second order. It's the second order function, right? It's the second order function. So therefore, we got, you know, this the convexity is like the coefficient of the second order term, right? It's like the coefficient of the second order term. So once the convexity is found, convexity is known, then we can predict the percentage change in bond price. And also, if we multiply bond price to both sides, then it will look like this. Then it's going to be, this is the way to find the bond price change. And this will be in dollars. Of course, this is dollars. This is percentage. Okay. I know it's a very heady thing, and it's, you know, but if you can follow, then that means, you know, you are like, you know, clearly, you know, this is more like, you know, graduate level. Okay, if you can follow this, you know, but you know, you don't need to know the Taylor series expansion, but at least, you know, you should be able to follow these steps, and then finally be able to use this. So our example, so here's the final example of the, here's the example of convexity. So maturity, 30 years, coupon rate 8%, original yield to maturity 8%, and the bond price is 1,000. Now, if the duration, modified duration is 11.26 years at 8%, and if the convexity is 212.4, okay, and we will verify if the if it is 2. But you know, you see, convexity is like this, so we can find convexity, right? But you know, if convexity is given like this, then let's predict the if the yield goes to 10%, that means 2% increase in yield. Of course, the bond price will fall, right? And we can calculate this, right? Because we can calculate the bond price. But you know, let's say before calculating the bond price, we can predict how much the bond price will change using the duration. If we use duration, right? Using duration, you know, percentage change in bond price is, you know, duration times change in yield. And duration is already negative, but when we show duration, we just don't use the minus sign, because it's the magnitude. That's, you know, what the duration is telling you is the magnitude of change. But duration is by its mathematical construct, it's supposed to be negative. Why? Because when the direction of the movement of the bond price and the yield is opposite. When yield goes down, price goes up. Right? When interest rate goes down, price goes up. When interest rate goes up, price goes down. So yield is basically negative. I mean, the duration is basically a negative thing. So we multiply 2%, which is the change in bond price, by duration. And what do we get? Negative 22.52%. But actually, how much did the price moved? How much did the price drop? 18.85. So actually, duration is overstating. Duration is overstating the actual change in bond price. But if we use convexity, using the convexity formula, right? And we will still need to use the duration. The first order term, coefficient of the first order term is duration times half convexity times change in yield squared. Then if we do that, we come to something like 18.27, which is close to the actual change in bond price. So now think about it. This this bond price was calculated by the bond pricing formula, right? So this is a like intrinsic value, right? So this is in equilibrium, right? The price will be like this, and the drop in price will be like this. But as I told you, the market isn't in the short run. Isn't that the market isn't rational, or the market price is an intrinsic value. It's always most of the times in the short run it's mispricing. So in that case, it may not be exactly 18.85, but it would be more like 18.27. Okay, and if the interest rate changes very small, convexity wouldn't even matter, right? If it is just 0.1% increase, right? Duration or convexity, they will all, changes, right? Changes, 1.126% duration, not that much different, right? And then convexity will give you pretty much the correct, right? Correct change in price. Well, I guess that's all the time we have. That's all the time we have. The rest of it, I want you to. So what time is it? I think we are already out of time. 8:45. That's exactly when we have to call it a night. So any questions so far? Any question? Anna, any question?
Not that I can think of right now.
Okay. Well, you're welcome to, email me the questions, or, if you get one. Okay. All right,
Okay,
then.
thank you.
All right. You're welcome. Have a good night and good weekend. And I will see you
You too.
next Thursday, December 9th, which will be our face-to-face day. Okay. I mean, you can exercise your option to be absent on that day. I mean, if you have made perfect attendance all this time, you are entitled to one absence, right?
Is that gonna
One.
be like a lecture that day?
No. On that day, there will be. I have. Let's see. What is the last day? This is what I'm gonna. Oh, there were things that were planned, but I'm gonna talk about 2008 financial crisis. Okay, and because we have I have a a video. We're gonna inside job, or so we're gonna discuss 2008 financial crisis. Okay, so
Okay, yeah, I
have a
saw
good.
it's on the
Mhm.
playlist on the YouTube.
What's
The
that?
inside job. I said I noticed it on the playlist for the one on
Oh
YouTube.
yeah. It's there. It's not just inside job. I mean, maybe I'm gonna play some other video because inside job people have seen, but there are other videos which are more, because inside job is a documentary, but it has some its own um, bias. But anyway, we're gonna be discussing 2008 financial crisis. All right, take care. Have a great weekend, and I will see you next Thursday.
All right, take
Okay?
care.
All right. So I'm gonna stop sharing. Stop recording.